Live from Bloomberg's European headquarters in London, welcome to our special coverage, the BOE Decides. The central bank, led by Governor Andrew Bailey, has held rates steady at 3.75%. The vote was split 8-1, with Hugh Pill dissenting. He called for a quarter-point hike. The Bank of England says there is a risk of, quote, material second-round effects, and the Monetary Policy Committee reiterated it stands ready to act if needed. Let's see how markets have been responding to this news out of the Bank of England and, in fact, all the other news we've had this morning. Guy, what do you see?
OK, let's price it all in and figure out exactly what is happening here. In some ways, you could argue that the decision we just had from the Bank of England and all the various scenarios we've been delivered could have been worse, i.e. there could have been a more hawkish tilt to all of this. On balance, maybe it is slightly hawkish, but the market is taking all of this into consideration and thinking about where it was. So once you price out the extreme scenario, you end up with a gilt yield at the front end of the 2-year that is down by, let's call it 7 basis points, 7 basis points exactly. So you've taken out maybe some of the right-hand tail risk on the upside on the hawkish front. You've also seen oil prices coming sharply down over the last few hours as well. So that's a factor you need to fold in to what you're seeing here. So you've had this kind of slow downward trajectory, a little move lower as we get the decision. We're now beginning to sort of bounce off that level. So that's what we're seeing at the front end. Let's talk about how this is being priced into the pound and what we're seeing in some of the domestic markets as well. So the pound is up by 0.3%. This is broadly in line with what we're seeing elsewhere in other currencies, currency swaps as well. And what you're getting is basically a move against the dollar. So that is a factor you need to bear in mind. The 250 is up by around 0.9% as well, more domestically focused, but nevertheless, equity markets as well responding to what we're seeing here, which is a complete reversal to what we got earlier on in this session, where Brent crude was rocketing upwards. We've now got Brent crude at 114.86. We are down by $3 or around 2.7%. So that's a big factor in what you're seeing in terms of the other assets that we are seeing moving around, Tom.
Let's get more details on that decision then and bring in Bloomberg UK correspondent Lizzie Burden, who is outside the Bank of England. So one dissent, and it is Hugh Pill on the hawkish end calling for 4%, but we're stuck with 3.75%. Lizzie, what for you are the key takeaways?
Well, Tom, as Guy said, this is a hold that could have been more hawkish. The vote split 8-1 as expected. Chief Economist Hugh Pill, the sole dissenter in favour of immediate hike here. We know that he's concerned about second-round effects from the energy shock from the Middle East war, but several other policymakers here saying that they might consider future hikes in response to that energy shock. The likes of Deputy Governor Claire Lombardelli, that was kind of expected. Dave Ramsden, another Deputy Governor, though, kind of a surprise. You've also got external members Megan Green and Catherine Mann weighing in on the hawkish side here. So, for the first time in this war, we've got new complete forecasts. They've set out 3 scenarios here, as you say. In all 3, rates go up. In the worst case scenario, they see oil at about $130 a barrel and staying there. But different members of the Monetary Policy Committee putting different weight on different scenarios. Hugh Pill, for example, saying that the risks of second round effects are to the upside. And yet, in response to this decision, we have, as you say, yields down because it appears traders are latching onto this line from the Governor, Andrew Bailey, that policy is in a reasonable place. So traders pairing bets on rate hikes this year. Before this decision, they'd seen 72 basis points of hikes in 2026. Now they see 67 basis points of hikes in 2026. So this press conference that's coming up with the Governor, Andrew Bailey, an absolute minefield. You'll remember the market reaction to the March decision. They didn't even have a press conference that time. And yet, saying that they were standing ready to act set off that outsized gilt market reaction. You could argue it was an overreaction because the governor had to walk it back. So today, Bailey is going to have to try not to sound too hawkish and trigger the gilt market again, but need to sound hawkish enough that in a few months' time, if this is still going, he doesn't look like the man who made a policy mistake and let inflation get out of control again.
Well, all that uncertainty, of course. Lizzie Burton on the ground for us outside the BOE. Lizzie, thank you. Reminder, of course, terminal users can follow all the latest news and analysis using the function TLive Go, TLIV Go on the terminal. We're also streaming this coverage on our Bloomberg TV YouTube channel as well. Anna.
Let's bring into the conversation Lawrence Mutkin, head of EMEA Rate Strategy at BMO Capital Markets, and John Stepek, Bloomberg senior reporter and author of the Money Distilled newsletter. Welcome to you both. We're 7 or 8 minutes away from Andrew Bailey and team starting to speak at the Bank of England, so we'll monitor for their arrival. Let's take stock of where we are. It seems to me that the Bank of England is in a sort of a dance with the markets at the moment. After the last decision, we saw financial conditions tightening quite a lot, and so everything they're doing is in that context. With that in mind then, Lawrence, what do you rate what we've got this morning?
Yeah, I think looking at the reaction that the market has had since the decision was made public, I think they'll probably be quite pleased with how it's gone, which is there hasn't been much reaction. And I think that what that tells you is that this bit of communication is within the envelope of what's already in the price. And as you say, and as they said, it's important to recognise that yields are already up. Monetary conditions have already tightened. And in a sense, this is a reminder that although we think of the term structure of interest rates as all being driven by the central bank, for the past 2 months, they haven't really been driven by the central bank. They've really been driven by the oil price and by geopolitics.
Yes.
And the central bank's just one player in this. And they're important, but clearly they're following the market. They're validating what the market's already done.
Yes, absolutely. And John, let's bring you into the conversation. That point about financial conditions is relevant because people in the UK have already felt the impact of the hawkish language, even without any hikes.
Yeah, absolutely. I mean, the most obvious place for a kind of normal person, if you like, where this would affect things is in the mortgage market. So mortgage rates have already gone up significantly this year. And really, one of the kind of big problems with that is that when we came into 2026, the market was expecting rates to go down maybe 2 or 3 times this year. And that was kind of underpinning the bullish case for the UK housing market and for the wider economy. And so that's basically already been knocked off the table without any movement from the Bank of England at all. But I also think the other interesting thing about this is the fact they've had to split the communication the way they have. So now rather than just getting, a vote or a kind of, this is the way that inflation's going to go, there's now 3 different scenarios and everyone's got to explain how they've come to their homework as well.
Very complicated.
Is it too confusing? Do you think this is too confusing?
I don't know that it's too confusing. I would say
is there a clear message?
There's an element.
Does it help? Does a clear message emerge from it, which is useful?
The clear message is anything could happen, and really it's all up to what happens.
I can tell you that.
You know what I mean? But this is the issue. There's an element of backside covering, obviously.
Yeah.
I think when you read Andrew Bailey's kind of rationale for why he voted, it's clear, at least certainly it's clear to me, that he would still rather not raise interest rates particularly dramatically. He kind of emphasises that he thinks scenario B is going to be the one, but he also says with slightly reduced second round effects. And that's certainly getting the vibe, if you like, from him that he's more worried about the recessionary impact than he is about the inflationary impact, and that's where he would rather fall. I don't know about you necessarily.
Lawrence.
I do think moving to 3 scenarios is very Bank of England.
Yes.
Right? In the same
what do you mean by that?
In the same way that rather than having, of course, you do have the joint statement at the beginning, but then you also have these little individual manifestos by each of the policymakers. So, as you say, the thing is that rather than having clear signal, you get a lot of noise, right? And you have to, the markets and the population have to discern the signal. Having said that, from the bank's point of view, it's obviously much more sensible to have 3 scenarios than to have a central case. And I think the key words really which explain it all are state dependent, because it is state dependent. And it's very Bank of England to acknowledge that it's state dependent rather than pretend that it's some kind of omniscient institution. So it's kind of consistent with how the bank acts, and I think it's all right in the sense that at least it's given markets a clear view or a clearer view of the reaction function, depending basically on the part of the oil price. It's all right.
John, there is this debate. It seems, when you read the statements from Hugh Pill versus Andrew Bailey, they have a different interpretation, or at least they're putting a different emphasis on the risks of, or the chances of, wage increases on the back of those higher prices, the higher fuel prices notably. And it seems like Andrew Bailey is less concerned about that this time round for various factors, but Hugh Peel says it's still a factor. What is your understanding of the ability of employers here to increase wages to offset some of this price pressure, and whether that is an inflationary risk further down the line?
The honest truth is, if you look at what's been happening to wages, I would probably come down more on the Bailey side, and employees might want higher wages. But we're already at the point where the private sector pay is basically flat in real terms. So, that if people...
It's below 4%, isn't it?
Exactly, yeah. And so if people were kind of, going to be getting pay rises, they would be getting them already, because nobody wants to, have their kind of wages eaten away by inflation. And it's pretty clear from where I'm sitting that the bargaining power of employees is not very good. The main thing that is driving wage inflation in the country at the moment, such as it is just increases in the minimum wage. So if you look at the data every kind of, month, the place where the private sector wages are going up the most is in the minimum wage heavy sectors, so kind of retail, wholesale, etc. Whereas you look at finance or manufacturing, then again it's kind of basically kind of real terms flat. So those people clearly don't have the bargaining power that perhaps Hugh is kind of worried about.
Right.
So yeah, I think the labour market is not something where they need to worry about inflationary pressure coming from.
And Lawrence, Hugh Peel then worrying about that a little more perhaps, but also emphasising speed versus scale of move, talking about a smaller move earlier, as if, because some people do talk about that. If you make a small move quickly, you prevent having to make bigger moves later.
Which makes sense, right? I mean, obviously, the move in the oil price just increases the amplitude on both sides of this stagflation thing, that inflation goes up more and the outlook for growth gets worse more, and they go in and out. So it's not obvious that you're supposed to change anything, because it's double-sided. And I suppose a small hike in that sense early might send the right message without meaning further. But I think they're right. It's not really in their hands. And if I may also say, I think it's also the case that the market and market interest rates at the moment are proving much more powerful than anything and this is not just the UK, any central bank can do with its overnight rate to banks.
With that in mind, I'll just point out that we are waiting for the team at the Bank of England to be assembled, the Monetary Policy Committee. So Andrew Bailey will at some moment walk through that door with the rest of the team. They'll sit down and then give an opening statement and then take questions from those assembled.
Can I just come back to the point that you were making, you guys were discussing? Is the Bank of England a price taker then in this kind of environment? Anna talks about a dance earlier on, and as they walk out, let's listen to your answer on this. Are these guys in charge, or is the market in charge?
They certainly have to validate the market's decision. Right. I don't think the market can. They can't overrule.
Is the market in charge of the dance? If you and I were dancing and I'm the market, am I in charge or are you in charge?
The choreographer.
The market right now is in charge, and that means the oil price is in charge.
Right. So the oil price is in charge of what happens next. Okay. You are looking at the room in front of you. I think we've got Claire Lombardelli, Andrew Bailey, Katie Martin will be doing the introductions. She will be speaking any second now. In fact, she probably is. Dave Ramsden is there as well. Katie will do the introduction, and I think Andrew Bailey is speaking. So let's have a listen.
We've held bank rate at 3.75%. The conflict in the Middle East has significantly affected the outlook for UK inflation. The disruption the conflict has caused to energy supplies has led to a sharp rise in global energy prices. CPI inflation increased to 3.3% in March and is likely to be higher later this year. Monetary policy cannot prevent higher global energy prices from affecting the UK economy and inflation. Our job is to set monetary policy to make sure that the effects of the shock do not become embedded into broad-based inflationary pressures so that inflation falls back to the 2% target and stays there. So I'll now set out how we expect higher energy prices to affect consumer price inflation before turning to the appropriate monetary policy response and the scenarios that have informed the Monetary Policy Committee's decision today. As I will explain, where we go from here will depend on the size and duration of the shock to energy prices, itself driven by how the conflict in the Middle East evolves, and how those higher energy prices affect consumer prices in the United Kingdom more broadly. Chart 1, which has just come up, shows 12-month inflation in the Consumer Price Index since the start of 2024, that's the blue line, alongside our updated expectations for the rest of the year. They're in the shaded area. Before hostilities broke out in Iran in February, inflation was on track to fall to around the 2% target from April. That's the red line. Recent data releases covering the period immediately before the conflict began suggest this expectation was reasonable. We now project that inflation will rise to a little over 3.5% by the end of the year. This change in the inflation outlook is a direct consequence of the conflict in the Middle East. Chart 2 shows the scale of the increases in global oil and gas prices. Volatility has been high, and the future path of oil and gas prices will depend on how the situation in the Middle East evolves. Uncertainty around any projection of UK inflation is correspondingly high. Higher global oil and gas prices have a direct effect on UK consumer price inflation. Chart 3 shows how these direct effects have changed the outlook for inflation since February. The prices of fuels moved quickly as global oil prices rose, and higher prices for petrol and diesel have already pushed inflation up relative to our expectations before the conflict. That's the green bars. Household utility bills, that's the orange bars, will follow and will mostly be affected when Ofgem's next energy price cap for the third quarter takes effect. At this horizon, higher energy costs will also feed through indirectly to consumer prices as firms pass higher costs through their supply chains. That's the purple bars. At first, the indirect effects on the inflation are likely to be largest for food prices, since food production and distribution are energy intensive. Further ahead, lower supply and higher prices of fertilizers may also push up on food price inflation through higher costs and lower yields for UK farmers and across the world. There is nothing monetary policy can do to prevent these cost increases from affecting UK businesses and households. The longer the conflict in the Middle East continues, the worse the impact will become. A resolution at the source, reopening the Strait of Hormuz and repairing the damage that has been done to the world's energy infrastructure, can, however, reduce the impact of this negative supply shock to our economy. The task for monetary policy is to ensure that, as the adjustment to the supply shock happens, inflation returns sustainably to the 2% target. The 2% target applies at all times. But the Monetary Policy Committee's remit recognises that attempting to bring inflation back to the target too quickly after a shock like this may cause undesirable volatility in output. Monetary policy must manage a trade-off between the speed with which it brings inflation back to target and the consideration that should be placed on the variability of output. Monetary policy generally looks through the direct effect of energy prices on inflation. It takes time for changes in interest rates to affect the economy and inflation, so the direct effects from an energy price shock may disappear from headline inflation before monetary policy can take effect. In that case, higher interest rates would only push inflation below target once the energy price shock had passed, resulting in undesirable volatility in both inflation and activity. Even if the lags in the effects of interest rate changes were shorter, offsetting the direct effect of an energy price shock would require pushing down core inflation by generating additional slack in the economy. Looking through the direct effects of an energy price shock avoids such output volatility, as the MPC's remit allows for. The remit also indicates that the MPC should manage a trade-off when considering how much to lean against the indirect effects from an energy price shock on inflation. But because they take longer to come through, the argument for looking through the indirect effects is weaker. Monetary policy can look through some of the inflationary impact from indirect effects to avoid undesirable volatility in output. But protracted indirect effects could keep inflation above target for too long unless monetary policy responds. So by leaning against indirect effects, monetary policy may also reduce the risk that higher inflation becomes embedded through higher inflation expectations and second-round effects. Second-round effects could arise, for example, if a rise in inflation expectations leads workers to bargain more strongly for wage increases and firms raise wages to maintain real pay for their employees, which in turn would increase their costs and could lead them to set higher prices. Monetary policy should not look through such effects, but the size of any second-round effects, in addition to the direct and indirect effects, is highly uncertain. On the one hand, the larger and more persistent the energy shock is, and the more inflation expectations respond to current inflation, the more likely it is that second-round effects arise. And inflation expectations have risen sharply in response to the current energy price shock. Repeated high inflation episodes over the past 5 years may have raised people's attentiveness to price increases. On the other hand, the strength of second-round effects will depend on conditions in the labour market and the pricing power of firms given the state of the economy. The UK labour market has loosened, and that trend has continued in recent months. This suggests that workers will be more cautious in wage bargaining. At the same time, firms may find it difficult to pass on cost increases to their customers, given subdued demand. Higher fuel and utility bills will themselves weigh on consumer demand for other goods and services through lower real incomes and weaker consumer sentiment. The uncertainty of the situation is likely to weigh further on firms' investment intentions. In addition to being highly uncertain, second-round effects build more slowly than direct and indirect effects. That leaves monetary policy with a difficult judgment call. Because interest rate changes take time to take their effect, monetary policy cannot wait for conclusive evidence of the strength of second-round effects. But responding too early may generate undesirable volatility in output, and inflation may drop below the 2% target in the medium term if second-round effects turn out to be smaller than anticipated. To inform its policy deliberations, the MPC has considered 3 scenarios for possible outcomes for the UK economy and inflation over the next 3 years. These scenarios illustrate that the path for inflation, conditional on a market-implied path for bank rates, in a 15-day window up to the 22nd of April, depends crucially on both the size of the energy shock and the extent of second-round effects. Chart 4 illustrates the assumed paths for oil and gas prices in each of the scenarios. In scenario A, oil and gas prices are assumed to follow markets futures curves based on the 15-day working day average to the 22nd of April over the next 3 years. That's the yellow lines. In scenario B, oil and gas prices follow market futures for 6 months and an average of the futures curve and a constant price thereafter. That's the purple line. This assumption reflects a more cautious view of the duration of the conflict and the time it will take to restore energy supplies through the Strait of Hormuz than implied by current market prices. Scenario C goes further to reflect the risk of a continued substantial disruption to supplies through the Strait, pushing oil prices to $130 a barrel and gas prices to 210 pence per firm, and remaining higher than in scenario A and B for the entire projection period. In scenario A, there are no second-round effects, in part because the energy shock is relatively short-lived, and in part because it is assumed that workers' bargaining power and firms' pricing power are too weak for such effects to occur, given slack in the labour market and subdued demand. Moreover, demand falls disproportionately more than would normally be assumed to reflect weak consumer sentiment after another supply shock. In scenario B, with a more cautious view of how the conflict may play out, the energy price shock is large and persistent enough to lead to modest second-round effects, under the assumption that workers' bargaining and firms' pricing powers are only slightly affected by the slack in the economy. Consumption responds broadly in proportion to what would normally be assumed in projections after an energy price shock in this scenario. Scenario C is more severe. The energy price shock is large and very persistent. And I would emphasise here the persistence in this scenario. And global supply chain cost pressures intensify. Inflation expectations respond strongly to continued elevated inflation, and firms are assumed to have sufficient pricing power for higher wages and costs to feed through more fully to consumer prices, resulting in materially stronger second-round effects. Chart 5 shows the paths of inflation and the output gap, that's a measure of slack in the economy, conditional on a market-implied path for bank rate based on a 15-day average of forward interest rates to the 22nd of April, along with the central projection from February. In scenario A, that's the yellow lines, inflation falls back quickly once direct and indirect effects have fed through. As the energy shock unwinds and energy prices fall again, while economic slack persists, inflation falls below the target at the end of next year. In scenario B, energy prices fall back more slowly and CPI inflation remains elevated for longer. Inflation then returns gradually to 2% by the second and third year of the projection, but with spare capacity in the economy. In scenario C, persistently high energy prices and second-round effects combine to push inflation above 6%, with inflation ending the forecast horizon above the 2% target. A materially tighter policy stance than embodied in the market-implied path for bank rate would therefore likely to be necessary in scenario C to counter second-round effects to ensure that inflation returns sustainably to the 2% target in the medium term. But that is not the case in the other scenarios. As chart 6 shows, 5 different illustrative policy rules all point to higher interest rates now than they did in February, given the change in energy prices across all scenarios. But the market-implied path for bank rate has also moved higher by about 55 basis points, measured by the 15-day average of forward interest rates to the 22nd of April compared to the corresponding path to the 26th of January from the February report. Since in February, market pricing was expecting rates to fall by around 40 basis points this year, the chart shows that for scenarios A and B, the illustrative interest rate responses would largely be accommodated by reversing out these assumed cuts without further increasing rates. But this would not be the case in scenario C. Since the end of the 22nd of April, oil prices have risen by more than 20%. Gas prices have risen by 8%, and the market-implied path for bank rate has moved higher by up to 35 basis points. But if we think back to early on the 8th of April, we saw similarly sized falls in energy prices and the path for bank rate in the day after the announcement of a US-Iran ceasefire. This volatility illustrates the unpredictability of the current situation as the markets are trying to assess the implications of the events and commentaries as they unfold. And I would just add for noting that the range on the Brent oil price this morning is over $10 a barrel. So that further illustrates the volatility that we're in. Given the sheer unpredictability and drawing on the evidence from scenario B, there's a good case for holding rates now. But we must recognise that a prolonged spike in energy prices, as in scenario C, could lead to a higher bank rate, while also recognising that a prompt end to the conflict and a reopening of the strait can take us to the more benign scenario, as in scenario A. So let me summarise. The MPC's decision to hold bank rate today is based on 2 key judgments. First, that continued weakness in activity and the labour market is likely to lessen the strength of second-round effects from higher global energy prices. But these effects are likely to be stronger the larger and more persistent is the rise in global energy prices. Second, that uncertainty about the strength of second-round effects means that monetary policy needs to balance the costs of leaning too little against these effects against the costs of responding too much. The right balance is likely to change depending on how events unfold. The situation remains highly uncertain. We will continue to monitor the situation in the Middle East and how it affects the UK economy and inflation very closely. This includes the size and duration of the energy price shock and its direct effects on UK inflation. It includes the state of the UK economy and how higher costs of energy and other inputs to production pass through to consumer prices. And it includes the potential for second-round effects of our wage and price setting, drawing on the full range of sources from economic data over surveys of firms and households and intelligence from our agents. I'm sorry that's taken a bit longer than usual, but as you can see, there are more scenarios and more to explain. So with that, Claire, Dave and I will be happy to take your questions. Thank you.
Go to Faisal and then Marine, please.
Thanks, Governor. Faisal Islam, BBC News. Can you just clarify in scenario A or B, so essentially that the oil price falls from here on in? I get the uncertainty underlying in the geopolitics, but that it may not necessarily require a rate rise? Is that what you just said?
Yeah, so look, obviously, the thing about using policy rules is that there are a whole range of policy rules and you can get a whole range of answers. But as the chart I showed a few minutes ago illustrates, and bearing in mind this point that there was 55 basis points of cuts assumed before, as this set of events started, the conclusion from that analysis is that there is a good deal of room to accommodate the type of tightening that would be needed in A or B within that range of 55 basis points. And of course, the curve has moved to reflect that. So I can't give you a cast iron assurance that therefore there will be no increase in any scenario or any of those scenarios. Sorry, but what I can say to you is that there is a good deal of space was available to accommodate that.
Maureen, and then Paul.
Mehreen Khan from The Times. Just on the flip side, it looks like, this week, scenario C, which is your most extreme scenario, severe scenario, looks much closer to where we might be at. There has been a huge swing in oil prices, but we hit the 126 mark today. If in June we are in a world where 126 doesn't look so extreme, do you then have to go into what you say is forceful action? And does that include putting a 50 basis point rate hike on the table?
Well, can I make 3 points on that, Maureen? And Claire may want to come in. And 3 points are these. First of all, scenario C, as I mentioned earlier, is a very persistent scenario. So the oil price remains above $100 a barrel through to the end of next year. So that's a key part of scenario C. It's not just where the price is today. That's the first point. Second point is that gas prices don't respond as much as oil prices. The third point is just to reiterate what I said slightly ad-libbing a few moments ago. I mean, this morning, if we'd had this discussion at 9 o'clock this morning, we were looking at a Brent price well over $120 a barrel. Well, I don't know what it is now, but when I walked into the room, it was over, over $10 a barrel, lower than that. So that illustrates, A, the volatility of prices, B, as the MPC, we just cannot, stop the music at a particular point in time and say that's it for all time because it is so volatile.
Yeah, I mean, the only thing I'd add is just to make explicit that point that we've set out 3 illustrative scenarios. They're not exhaustive. They're there to explain, basically, and show how the economy may evolve and how policy might need to react to those. But it's quite likely that the world won't be like, in any of those precisely. And so this is to give a sense of, as I say, how it will flow through the economy potentially and our reaction function.
Paul and then Sue.
Paul Kelso, Sky News. Governor, a question about scenario C, what we might call the worst case scenario you set out today. Consumers will see potential inflation at 6.2%, interest rates at above 5% again, and they have very recent memories of what that feels like. We've had extraordinarily high inflation from which many households haven't recovered. And I suppose the question many will have is what they're looking for is a sense from you of how likely is that to come to pass?
Well, going back to the point I made in response to Maureen's question, the sheer volatility of what we're looking at makes it, I think, very hard to put probabilities on things. This is the problem, one of the problems we're dealing with. So, we've been very careful not to put probabilities on these scenarios because it moves around too much. I think the point I would make, though, and I think reiterate something I said earlier, this is very important. The longer this general state goes on, the more difficult it becomes. I'm afraid that is something we can sort of fairly easily deduce. So look through the volatility. The longer this problem goes on and the longer the disruption to energy supplies goes on, other things equal, it's likely that therefore energy prices will stay higher and the more difficult the scenario we're in.
But the one thing I would add is the numbers that in that scenario show what happens under the market path. So assume the market path. If we were in a scenario where we saw much higher inflationary pressures like that, we would, of course, have to take policy action to lean against them. And so that would bring inflation down.
Sue in the middle, and then Joel up at the top there. She's down here. Yeah.
Thank you. Sue Chan from The Telegraph. Just following on from what Mehreen asked, if we are in a situation where oil prices remain persistently high, what does forceful look like? Are we back in, a 2022 situation where we saw 50, 75 basis point rate hikes? And given your comments just now, when will you have enough info to help you decide that rate hikes might be needed?
Well, I'm not going to put numbers on what forceful looks like, other than to say I think the point was made very deliberately to say that if we see that type of very difficult scenario emerging, then it's important that we obviously do respond quickly to it. But I don't think it's wise to put numbers on it. Your question is a very good question. When will we see it? And it goes back to something I said in my opening remarks. I mean, the challenge for us, and this is the second round effect point, because judging the second rounds is crucial here. Now, of course, the problem is that the second round effects emerge much more slowly. And that's in the nature of it, really, because they're the sort of the follow-on, if you like. And it would be a mistake to wait to see the second round effects before acting, because then it would be too late. So by way of saying it's a judgment that we will have to make at every meeting. And this is why I stressed right at the end of my remarks that we will be looking at a very broad range of evidence. Some of which will be quantitative, but some of which will be qualitative, based particularly on what our agents are telling us as to how it is affecting the economy. And I would say from my visits around the country, and I'll be out and about tomorrow. We do start in a position where firms very typically say to me they have been experiencing difficulty in passing costs on into prices. But obviously, as this shock is a new feature. Then, I mean, that was the sort of the ex ante state, if you like. Obviously, they're now faced with an abrupt energy price shock, and so we will have to then judge carefully how they both can and do respond to it.
And just on that, if I can just add, in terms of one way of thinking of the scenarios, there are two dimensions to them. One, as Andrew's been emphasising, is the persistence of energy prices. And the second dimension is the strength of second round effects. The persistence of energy prices will obviously, that will be more and more apparent as time goes past. The extent of second round effects will be much more of a judgment as the evidence emerges over time.
Joel up at the back there, and then Sam.
Joel Hills from ITV News. Given that a key judgment is on higher prices and how they feed through and create second round effects, what exactly will you be watching over the weeks ahead to form that judgment? And with people feeling worse off, isn't it natural that they'll ask for higher pay?
Well, let me take it in two parts. On the first part, I mean, what I did was set out very deliberately a sort of, in a sense, a sequence of things that you look for. So you start, obviously, with the first round effects, which are energy prices themselves. Then we talked about indirect effects, which is how it passes through into the cost of production of other things. And I did put quite an emphasis on food, because I think one of the things we learned 4 years ago was, what a considerable share of the cost of final food is energy. Processed food is energy, so that's important. And I also emphasise food because energy and food are the two most salient things in the basket, the consumption basket, I think, for people, because they're the things we buy most often and most regularly, and we can compare prices more easily from time to time, therefore. And then we get the second round effects. So those, in terms of what will we be watching, those will be the things we'll be watching. On wage setting, I mean, wages are set in labour markets. Let me make an important point here. Labour markets at the moment are functioning efficiently. There's no reason in any of the very considerable analysis that our staff do on the labour markets to think that otherwise, anything other than that pay is being set efficiently. Now, it will, I should say, be some time before we really do get a read on pay, and the reason is the seasonal cycle of pay setting, because most pay settlements, a large part of the pay settlements are done in spring. So we've actually passed through that period for this year. You're probably immediately going to compare that back to things I said 4 years ago, and I would just make the following point. Coming out of COVID, the labour market was much less efficient. It was not functioning as well. A lot of work our staff did on job matching was showing there had been a real increase in the inefficiency of the labour market in that sense. But we're not in that place today. Wages will be set in markets.
Sam right there, and Josiah.
Thanks very much. Governor, you put in your statement some weight on scenario B, I think. That in terms of the inflation forecast based on the market curve going into the meeting, that puts inflation on target at 2% along the inflation horizon. But that implied that market curve at least a couple of rate increases. That was the curve at the time which generated that forecast. So is it reasonable, therefore, to expect some tightening from here under scenario B? And the minutes themselves put a lot of weight on tighter market conditions, taking some insurance out in terms of adverse inflation outcomes. But at what point do you need to actually validate the tightening in the financial markets by raising interest rates? Thanks.
Well, Claire's come in as well on the final point. Let me start on scenario B. One of the reasons that I think there's one element of scenario B that is more plausible than scenario A, and that's the energy price profile, and particularly probably the gas price profile, because the market curve, which is scenario A, I think does assume that let's be very optimistic for a moment and say the conflict is over tomorrow. It assumes quite a rapid return to pre-existing supply conditions. Now, that's not really consistent with what we hear, and I'm sure you hear from people who have looked at the damage, for instance, that was done to the gas production infrastructure in Qatar, for instance. Where I think the view that we hear is, look, it is going to take a while to repair that. There's some pretty key parts were damaged. So scenario B, in part, is motivated by building that into the assumption. Now, on the point you raised about interest rates, look, the right decision today is to hold. But it's an active hold in that sense. It's not a passive wait and see hold. It's a deliberately active hold because, as I said earlier in response to the earlier question, there's a range of scenarios in our view where the headroom we'd got, because let's say it's quite clear that the prospect of cuts, which we were after all talking about at this conference, the press conference 3 months ago, is not on the table now. That headroom could take it up, but we can't give you any assurance on that front. Claire, did you want to know?
No, only to add, I mean, as we've mentioned, we haven't put probabilities on these scenarios. You couldn't, I mean, for obvious reasons. So different members will think differently about how they want to weigh the risks of a higher inflation, more persistent scenario, and whether or not, they want to adjust policy in response to it.
Josiah, who's right in the middle there, yeah, and then Subhan.
Yeah, Shapopovich, Central Banking. So my question is just with regard to Alan Taylor's comment that given neutral at 3%.
Sorry, could you just, the acoustics are terrible in this room for when you're sitting here anyway. Could you just talk up a bit? That would be really helpful. Thank you.
I'll start again. Can you hear me now?
Oh, that's great, yeah.
Great. So, Shapopovich, Central Banking. I just wanted to ask about Alan Taylor's comment that given neutral at 3%, it makes sense to hold. I just wanted to ask where that figure comes from. Is that a current staff assessment or a hypothetical? And what are the governors?
I can do it.
Oh, can you?
Yeah, I could hear enough.
Got better hearing than I have.
Maybe. I think that's Alan's estimate of neutral. Yes. I mean, it's in his paragraph, so it's his estimate of neutral. In the past, we've published a range of estimates. Claire and I have talked about them extensively at these press conferences, but on different models, different approaches, you can get anything from 2 to 4%. He's been very clear and consistent that he sees neutral as being around 3, so that's very much his estimate.
I think we've said before, some members of the MPC are more confident in their estimates of the neutral rate, and some of the rest of us, I include myself in this, are less confident about precise estimates, and that's fine. Reasonable people can disagree on that.
And Subhan, who's right behind you.
Thank you. Governor, what evidence would you need to see to vote for a rate hike? And are you close to voting for one? You said you put some weight on scenario C, even if not as much on scenario B. What would you need to see that pushes you to scenario C and is that evidence likely to come before the next MPC meeting?
What would push us to scenario C?
Yeah, and is that
give greater weight to scenario C, I think. Well, look, I think a lot of it does hang on what happens in the Gulf, because scenario C is in the first instance motivated by more persistent first-round effects. It also has a stronger second-round effects in it, but as I was saying earlier, I think to Sue's question, they take longer to appear on the scene, as it were. So in the first instance, there's a difficult judgment in there about how long is this going to go on for, and that's important because persistence is an important element of scenario C. And what I would emphasise, though, the reason this persistence point is important is that if you look back to 4 years ago, energy prices went up, and particularly gas prices 4 years ago actually went up, but they came down quite quickly, actually. Scenario C doesn't look like that. It's actually it's a different shape to the profile. It's got a much longer downslope on it.
Heather, and then John Paul.
Heather Stewart from The Guardian. Governor, you were at the Prime Minister's Cobra meeting, I think, earlier this week about managing the impact of the crisis. I just wonder what the role of the bank is in that. Are you advising about the inflationary impact of potential policies, for example, or should we infer that there's a concerns about financial stability impact of what's going on? What's your role there? Well,
my role, and I have to be quite careful about my role, given it's an interest rate setting week, is to really, as I think there was a very short record or note of the meeting issued, it was merely to sort of, in a sense, outline the macroeconomic framework, and it really was framework. So, by the way, the meeting was confidential, so I'm not going to talk in any detail, but you won't probably be surprised to know that I sort of laid out first-round effects, indirect effects and second-round effects in terms of the sort of how it works in principle.
John Paul?
Hello, John Paul Ford Rockhouse from the Daily Mail. Can you hear me all right?
Yeah.
Couple of scenarios. Scenario A, which you've just sort of implied is rather unlikely given the energy profile, seems to be the only one under which it's likely that interest rates may not need to rise. Therefore, does it look almost certain, should people take it who are watching and listening to this, that get ready for rate hikes? Is the message. And sorry, and one further thing in relation to that. Scenario C, at 5.25%, the report suggests that would raise the risk of a recession. Is a recession a price that we will have to pay?
The answer to your first question is no. Scenario A, you're right. I, for my own part, think that the market curve on energy prices, particularly on gas, is too optimistic in terms of the time it would take to restore supply. But scenario A has other features to it, and particularly the question about the second round effects. And the second round effects are to do obviously with the length and duration and impact of the energy price shock. So the shorter this whole thing, the less we would expect the second round effects to be. So, scenario A is not there for sort of decoration. It's very much a sort of, part of the scene in that sense. And as I said earlier, then also, parts of scenario, a good part of scenario B would be accommodated by, a lot of scenario B would be accommodated by the headroom that we already had. So I would very much, give the message, no, it is not the case that we're sort of giving some sort of slightly clandestine message that interest rates are going to go up, notwithstanding what we've decided today. As I said earlier, today is an active hold in that sense.
And the only other factor I'd add on scenario A and the likelihood of second round effects, and obviously different members of the committee will have different views on this, but this, we have really drawn attention, and Andrew has consistently in recent weeks, to the continued looseness of the labour market. Yeah. And that is a very different position for the labour market than we were in 2022.
Oh, recession. So what I would say is, when you look at the analysis that we presented using market curves, scenario C does not deliver a recession. Now, as I said earlier, there's a whole range of policy rules you can attach to these things, and you can get a whole array of results. And there are some policy rules which will deliver you some short periods of negative growth. But however, that's not most of them, actually. Most of them don't do that. So the basic message is this actually delivers a profile of slower growth.
Tom and Deirdre.
Tom Rees from Bloomberg News. As you've suggested, what we've seen in the first 2 months of this conflict is actually just a lot of volatility in prices. Crude going from $80 a barrel to 126. If that extreme volatility lasts much longer, do any of these scenarios capture something where prices just fluctuate quite a lot? And I was just also wondering, how much has your thinking changed in the last week? Has the outlook got a lot worse over the last week from what we've seen in energy markets?
Well, two things there. Thanks, Tom. First of all, of course, volatility is hard for all sorts of reasons. It's hard, when you're taking decisions. But you've also got to think about how volatility feeds through into people's expectations. This is a more problematic element to it in a sense, because obviously people are quite saying, well, I don't know what is the. I mean, the first starting point is what is the price today? Because I said earlier, if you checked into the Brent oil price at some point, this morning, you would get very different numbers depending on what time you checked in at. So that's a further complication as to how people form their expectations. On your point about the last week or so, I mean, you look at the oil price curve. You had obviously it went up. Then you had the period when it was coming back down again, and now it's gone back up again. All of that hangs off, frankly, what's going on in the Gulf. And what's being said about even more so, actually, sometimes what's being said about what's going on in the Gulf. So, I think certainly for myself, I think we have to be quite careful here in terms of, I don't sort of pin my reading of the world on one particular period of time, because frankly we've seen such changes since this whole conflict began.
Deirdre and then Maurizio.
Hello, can you hear me?
Yes.
Okay, sorry, you never usually can. I just wanted to raise a point in the minutes. It talks about the indirect effects of high energy prices on production costs, likely to affect food prices particularly.
Yes.
How much do you think that is going to affect food prices? And it says inflation is expected to rise somewhat further in Q4. So does that mean that Christmas dinner is going to be more expensive?
Well, because unfortunately a lot can happen between now and Christmas. I mean, just to go back to, as I said, go back 4 years. Obviously, you can't generalise because obviously different foods get made in different ways. But it wasn't when we looked at it 4 years ago. There are quite a few processed foods where 30% of the cost is energy. So obviously that's significant. But then let's consider that, as I say, the pass-through. I mean, the question, of course, in the current conditions, current conditions for demand, current conditions in the labour market, and what firms are telling us about their ability to pass costs on into prices, which has definitely become more difficult. There's no question about that. We get that all around the country. I think it remains an open question, therefore, what the impact on final food prices is going to be. I mean, that remains to be seen. And I would just re-emphasise also the point I did allude to in the opening remarks about the other effect on food, which is the impact of the problem in fertiliser supply, which again will of course come through over time. Although I know farmers are already telling us, of course, that they're having to make decisions on what they think fertiliser availability is going to be as to what they plant.
We put a bit more detail than in the minutes in the monetary policy report on food prices. So if you look in page 14, you'll see that we say that our short-term forecast out to September 26 takes them up to 4.6%. But then the reports that our agents are getting suggest that they might go up further to a range of 6 to 7% by the end of the year. But that's based on reports as of now, late April. And as Andrew says, a lot can happen.
Maurizio here, and then Ritika up the back there.
Hi, Maurizio Alencar from CCAM. Governor, after the last meeting, you said that markets were getting ahead of themselves.
Yes.
And then now you're sort of saying it's an active hold. And I think the minutes report also say that tightened financial markets have become an insurance to sort of inflation. Do you risk sort of actually confusing, the traders out there in the city about what the bank's next move is? And I suppose what's your sort of response?
Let me, totally fair question. Let me get a little bit of sort of how we got through the last meeting to here. I think that's helpful. We obviously saw quite a move in markets at the time of our last announcement, and I think it comes back to earlier questions. Actually, we were very conscious. I was very conscious that we were expected to cut rates this year. And indeed, look, it wasn't. I go back to the last press conference. I said it. I've said it a number of times. I thought that was my central expectation. And effectively, in the last meeting, in the last minutes of the last meeting, we took that off the table. And I think that we had to do that because, frankly, as you'll see from the material we've presented this time, it's just not realistic. Sadly, but it's not realistic. Now, we know that markets, and this is totally understandable, were pretty substantially positioned based on what we had been saying. That's understandable, totally understandable. And the consequence of taking those cuts off the table was quite a sharp move in the curve. I was not surprised by that because I say that in a sense was sadly a fact that followed on the outbreak of the conflict. We did get to a point, I remember, when the 4 or 5 increases were being priced in for this year, I think, and I did make this point. I think you're getting ahead of yourselves at this point, and I would stick to that point. And what you see what you see in the much larger amount of material we've presented today is a very broad analysis. As I've said, we've all said a number of times in response to questions. The scenarios show you that there are paths through this where we don't get any more increase. We don't have to increase rates, and the scenarios, I'm afraid, where we do have to increase rates, and that's where we are today. So, look, as I think we've said, and I've said in things I've said today, it's an active hold today. Do I think, therefore, that the interest rate curve is in the wrong place? No, I don't, because there are risks around this.
Ritika up at the back, and then Francine.
Ritika Gupta at CNBC. So there's questions about if you wait for the hard data, whether that means you're going to be behind the curve. So if you did go ahead with an interest rate hike, but then you wanted to reverse that, say there was a quicker resolution to the war than you anticipated, how would you then communicate that to the public? Would you see that as a high cost to reverse that decision?
Well, it's a very good question. First of all, we are in such an uncertain world that, you're right to say, but you don't want to be the people who increase interest rates, and then the next week this whole thing gets settled and everything goes back to normal, and you end up sort of thinking, why did we do that? Well, unfortunately, that's the world we're in. It's a very volatile world, so we have to recognise that could happen. I don't think any of us can predict that, but it's a world we could be in. And I think the important thing is that we have to take this decision over, at every meeting.
I'm just going to briefly interrupt the Bank of England governor because the ECB has announced its rate decision, fully expected, of course, to hold rates, and that's what it's done at 2%. That was the unanimous expectation from economists. Checking euro-dollar right now at 117, largely unmoved, up 0.2%. That's more down to the downside pressure we're seeing on the dollar in the session today. Markets pricing in 3 hikes, almost 3 hikes fully priced in for the ECB. The ECB holding, though, at this point at 2%. The ECB saying upside inflation risks, downside growth risks have intensified. That's a red head across the terminal. The ECB sees upside inflation risks and downside growth risks have intensified. The ECB keeping that deposit facility rate at 2% as expected. President Christine Lagarde, of course, that news conference is at 1:45 p.m. Stay with Bloomberg for that. Let's take you back to Andrew Bailey at the Bank of England.
What we're looking at in terms of direction of travel, because it is quite volatile. Are you expecting things to settle down in one direction or the other?
Unfortunately, I don't think. Well, look. Obviously, to state the blindingly obvious, we will know more. So that's a obviously not particularly useful thing to say, but it's just worth saying to start with. Will we be in a position where we can say with certainty that we'll know which scenario we're in? No, I'm afraid we won't, because, particularly going back to the point we've made about scenario C, which is it's a lot of what drives scenario C is persistence. It's got stronger second-round effects, and we won't know with certainty the answer to that.
Yeah, we'll obviously know more about what's happened to energy prices. We'll just have more time, so we'll have seen the conflict and how that's progressed, and so we'll have a better sense of the persistence of that. On the second round effects, as the Governor says, we'll know more about them from tracking certain things. We will be looking at inflation expectations, we will be looking at wages, we will be looking at pricing power, we will be looking at actually how households respond. Are they smoothing incomes, are they not? We will be looking at what all of these groups are saying about their intentions. So we'll have some more information, but will there be a moment where you can clearly say second round effects, inflation persistence is taking hold? There won't be a sort of moment like that, but of course we'll have a lot more information, and we'll be doing a lot of analysis, including, as the Governor says, talking a lot to our agents who are out and about around the country, now, and we'll continue to be talking to firms about what their intentions are.
Harrison Moore, Market News. You've noted that tighter financial conditions are already working in your favour, already somewhat constraining a potential rise in inflation. Are you able to quantify in monetary policy terms how much effective tightening there already is, and what data are you looking at in that space?
Okay, Dave, do you want to?
Well, in terms of how we've sort of framed things for the outlook and the three scenarios, and therefore the policy decision, we've as Andrew has emphasised, as we've set out, we've conditioned the big tightening has come from the consequences of what's happened to energy markets onto rates markets. So the curve that the three scenarios are conditioned on is significantly different than the one we had in February, when I think when the curve then pointed to about 40 or so. I think if you look at the difference between the February curve and then where we are now, you've got minus 40 plus 55 or so.
Bank of England officials speaking there following the central bank's rate decision. Let's recap what we've heard. Let's take a look at how the markets have responded to what we've heard, Guy, from the Bank of England, and to what's been happening with oil prices in the meantime.
Quite hard to decide at this point, actually, which is having the greater effect, the Bank of England or what is happening actually with the price of crude oil. I suspect it's the latter. So what we've seen, this is the kind of the price picture you've seen this morning, the yield picture. We've seen yields coming lower. This is the front end of the 2-year. You get a kind of a move down at around 12 o'clock. But you've also got a fairly sharp decline at this point in the price of crude as well. And UK 2-year yields are down by around 10 basis points. If you take a look across the rest of the front end across Europe, not too dissimilar, actually, the moves that we're seeing elsewhere. And you saw actually a little tick lower as we got the ECB decision coming out. So while I think the Bank of England is having an effect at the front end this morning, I'm not sure it's that big. And I actually think probably the next chart I'm going to show you is having potentially a greater effect. We went into the press conference talking about the idea that actually the Brent price, maybe the gas price, is in charge of the narrative here. And you can kind of see the move that we're getting here, lower in crude prices. That appears to maybe be having a greater effect on what we're seeing sort of all the way across the front end of the curves, all the way across Europe. So actually, central banks are setting interest rates, but it's the Brent price that is really determining kind of where we are and the absolute levels that we're watching, Tom.
So Governor Bailey then just wrapping up that BOE press conference where he focused, of course, on how the war in Iran is impacting the UK economy. Take a listen.
Where we go from here will depend on the size and duration of the shock to energy prices, itself driven by how the conflict in the Middle East evolves and how those higher energy prices affect consumer prices in the United Kingdom more broadly.
Let's bring back in, at this point, Lawrence Mutkin, head of EMEA Rate Strategy at BMO Capital Markets, and John Stefek, Bloomberg senior reporter and author of the Money Distilled newsletter. Lawrence, was this a reminder of just how in hock the BOE and other central banks are now, how at the mercy they are to those oil prices, as Guy was saying?
Yeah, and I think, to be fair to the Governor, as he was saying, in terms of that's what state-dependent means. State-dependent means the world affects us more than, in some ways, we affect the world, right? And these exogenous variables of the oil shock are very compelling inputs into the bank's decision. There is, in fact, I've been looking through the monetary policy report. They have got a large box at the back about how central banks should be dealing with energy shocks. All lots of sensible stuff. The only thing that I think might alarm the gilt market is at the end it talks a bit about it says monetary policy must consider how to manage the trade-off between the speed with which inflation is returned to target and consideration that should be placed on the variability of output. Now, that is an important decision for the economy, but it doesn't really matter to people who get fixed income cash flows in the future. Gilt investors are kind of broadly indifferent to the variability of output compared to the present value of their future cash flows. So I think that might explain why. I mean, we've seen a nice rally in the market, obviously, as Guy says, caused as much by perhaps the energy price as this meeting, but nonetheless, the bank did nothing wrong with this meeting. But this sort of thing means that the forward rate, the implied forward rate at the back end of the curve, has barely moved down, even though the spot rates have moved down a lot. I think it's always a concern, really, if you're a bond investor. You need to have the central bank very solidly put its cards on the table and say, we care about inflation most.
Yes. Ultimately, the mandates. John, this is a huge tax. We were talking about it as we've been listening. This is a massive tax. If the Bank of England raises rates, and it sounds like it kind of... Scenario A, the governor doesn't really believe in that. In all the other scenarios, we're going to see potentially rate hikes here. They're just going to compound the problem.
I guess this is the challenge for central banks. They have to kind of crush the economy to save the economy when something like this happens. You get the oil price goes up. All that does is it takes away from the amount that consumers have to spend on wants, and it increases the amount they have to spend on needs. So it's the kind of thing, if you put VAT up by 20%, you would expect the economy to crash, and it's a similar sort of dynamic. I guess that's why they focus on, well, that's why we need to wait and see what the second order effects are. And I guess where my sort of sympathies are, I think, with Bailey here, are that I just don't see that the second order effects are going to be... I mean, for example, it's going to be nothing like 2022. Because 2022, we had absolutely so much pent-up demand and exploded out. Whereas this is probably more like 2011, where, we were just kind of coasting to go off the edge of a cliff. Probably not as bad as that. But.
Lawrence, to this point about whether we get interest rates in scenario B and C, it did seem as if they were saying in scenarios A and B, there's a world where you don't get an interest rate hike because the market's kind of done that already.
I think that is exactly right. But again, I think to the point that John made earlier, the interest rate hikes already happened in 2-year and 5-year fixed rate mortgages. And it's a reminder that what central banks do is they control an overnight rate between a central bank and a small group of financial institutions. And the way that it's supposed to work with the economy is that's supposed to promulgate along the curve in terms of the credit curve and the yield curve. But in times like this, the bond markets are saying, I'm sorry, inflation's going to be 4% this year. I just can't really be taking this low yield to lend money, and it's kind of interesting what the central bank's doing, but it's not the first determinant, perhaps, of what yields have to be.
I think another area of uncertainty which the bank cannot get into is politics. We don't know what the political reaction function is going to be to this.
Yeah. We're going to find out very shortly, though. May is coming. May elections are coming. Guys, thank you very much indeed. Lawrence, very nice to see you. For stopping by to see us. Lawrence Muckin, Head of EMEA Rate Strategy at BMO Capital Markets. And also our thanks to Bloomberg's John Stepek. If you haven't already signed up to the award-winning newsletter...
You got yours out today?
Make sure you do. It's nearly out.
Nearly out. OK. Later, Francine Lacroix will be speaking with Governor Bailey, so you can catch that interview at 4 p.m. London time.
That is it for our special coverage of the Bank of England rate decision. We'll take you back to our colleagues on surveillance in New York.